Hello, YouTube. Could we be headed for a negative 10% drop in 4 weeks? Because the last time this pattern played out, we had a 10% crash from the close of the last candle. So, what pattern is this? Well, it's a double engulfing pattern, which means we're basically signifying that we're creating a megaphone where we have higher highs and lower lows. What's particularly interesting about this level as well is that it is right around 384, which is where we have a technical bear market. And we're set to resume our daily downtrend or bear market trend going back to the start of the bear market at the end of 2021 and 2022 with our candle close here on Friday. There are a lot of warnings, so please stay tuned. And through this video, we're going to walk you through exactly what to look for, how to get prepared, and more importantly, what are the warning signs from this pattern? Because if we're right or wrong, it's going to be really important. Remembering that about 2 weeks ago, we were looking for a potential trend change on the S&P 500, where the lower wick signified the move higher, the upper wick signified the move lower. Last week, we talked about how this was bullish, meaning we had a bullish engulfing weekly candle, but the question was whether or not it was going to hold. And as of right now, it did not. Even I was wrong this week. I thought we were going to go higher, but there's some things like SVB, which we cannot predict at all. So we're going to go through all of that now. Let's jump forward. We got Mike Wilson here, and we're going to talk about the Bears because if the Bears want to capitalize, now is the time. And the reason why in the video I called it a bull trap is because that's what Mike Wilson's calling it, testing critical levels. Given our view that the earnings recession is far from over, we think March is a high risk month for the next leg lower in stocks. Ultimately, we think this rally is a bull trap. If it is a bull trap, the story for me is fairly simple. It means that we're going to be falling back below our bear market level by just falling back below this red line. That is the area that's been an impenetrable fortress, and how we could ultimately fade back down to our October low. So that's what we're going to talk about today. So if we look here to our weekly chart, let's now delete everything here and try to just get a grasp on what this means. So we have a double. What's so interesting about this actually is that if we look a little bit objectively here, we have a reversal pattern. We have the same thing happening here. Okay, reversal. Couple of red weeks. Boom. On the 1 week we closed green, bull engulfing. What happened here? Bull engulfing. What's happened? What happens immediately after that? Bearish engulfing. Here's the bearish engulfing. So here where I was right, and here's where I was wrong. I thought last weekend that we were going to get a failed breakout where we break above the previous range but fail to hold it. That worked. The first half worked great. Here's where I was wrong, and I think a little bit of humility is going to be needed in this market because fear and greed is just jostling so fast right now. We were at 79 in early February. Now we're at 24. Extreme greed to extreme fear within a month and a little bit. So why does this matter? Well, it matters because if we're truly going to be going lower by closing below the previous candle lows, all it's going to take from me is that if we're going to get a dead cat bounce back up higher and we have some catalyst for that, we have to close above both of these candles low because the last time this pattern played out and we got that upper wick, right? We closed near the low of the candle. We get a little bit of a dead cat bounce. We basically push back up to the previous candle lows. So what would that signify right here? Well, that's about 390 to 393. It's 392 and 393 to be precise. And that basically corresponds with the last 2 weeks low. Here is where, if we're being objective, we have a bearish pattern. We have a rejection on our 50 MA and a bearish engulfing. We also have the pattern repeating or a double engulfing. What does the volume say? Well, every elevated bar since the 24th of January, or at least the last 12 months, elevated red, 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 red. So the fact that we've been able to rally, because we've rallied like 20% twice. Our October low rally is about 20%. Sorry, this rally right here is about 20. Our most recent rally is about 20. But that just is like kind of a short covering rally or a seller exhaustion rally. Sellers are exhausted and they come back in short the higher level. That's what's so interesting here. So if we continue the story now, and it's very simple, right? Okay, well, if now we're getting early evidence that we're falling below here, and this is interesting because previously for about the last 2 months, every time we back tested our breakout, it became support. It was resistance, was resistance, was resistance, but then it became support. So like it changed fast. Yes, gold up, VIX up, things are moving fast. And here is why we have to pay attention this week. Because what I laid out at the end of December was that We have a 12-month bearish engulfing pattern. And if we're green, great. If we go red, well, we have to be very careful because the last time this played out, it was nasty when it was red. Nasty when it was red was the 1970s. I was not alive. I was born in the 1980s, which means all I can look at is the chart to try to understand the price action. We're looking at a log scale too. So if we go to arithmetic, you're not even going to notice the stuff. So if we look here, why are we looking at this week? Well, because now we're only up by about 0.58% on the week. That is not really all that much. When at the high of the year, we were up like 6%, 7%. So now that we are within 0.5% of going to red on the year, the levels that I were looking for me, I'm looking at the levels right here, 37.60, 32.47. But with the precipitous drop or it happening so fast, they might hit, they might not. We have to just be very mindful of them. So as we continue the story here, we can also look here to ARC. And I'm going to ask one time, please, and thank you, if you could please consider smashing that thumbs up and subscribing to the channel if you're enjoying the content. I put a lot of work into this weekend's video. All I ask in return is that you support me with a thumbs up. And if you're enjoying the content, just consider joining our YouTube community. That would be greatly appreciated. Here we're looking at a fear and greed map for ARC. We're looking at a log scale. And for me, it looks eerily similar. So when we look at the psychology chart, I go over, the line chart comes in. If I delete it, you can see the pattern pretty much repeats. We have our double bottom right here. Sorry, we have like a double cut. So let's change the color so it's a little bit more obvious. Let's go to black. So we have our double bounce right here, which forms a W. Then we go all the way down. We dead cat bounce again, and then just bounce around inside of here. If we look at ARC now, so let's remove the the backdrop here. Let's delete it. And then we look here. Okay, we'll bring it back in a moment. But here's what's interesting to me is that we've been unable to claim the 50 weekly, which is going to be the long-term chart or the 1 week chart, long-term support. So long-term chart, the weekly chart, long-term, short-term support. If we can't get back above that, the long-term price or the weekly is not bullish because we're not above the short-term price. We also have a very clear pattern here, which could be getting carved out, or a inverse head and shoulders. So to bring this back here, I'm like, okay, well, if we're going to be getting another leg lower, like it could be the last one, it could not. I could see everything kind of setting up here. And ARC is just the most extreme example of the psychology. So as we're thinking about what traders should be doing and not be doing, and fear and greed is like really bouncing around, we have to pay attention to these levels. Another reason why this is important for me is because if we now look to Bitcoin, BTC, USD, what we're going to notice that if we go back, so this is on a log scale too. Let's go to arithmetic just because it's probably what you guys are used to seeing. We're going to note two areas here. Why? Well, because a lot of this debacle is around SVB or San Francisco Bank, and then also Silvergate, which is exposed to Bitcoin. And after hitting 25, which also aligned with my psychology chart that I posted on Twitter, what's happening now? Well, we're back testing the previous all-time high in 2018. So if this is previous resistance turning into support, 20K should hold. There was forced liquidation, including, I think, $3.2 billion in crypto funds were exposed to SVB. And they have over $100 billion in deposits. So like that kind of really matters. So what I'm trying to get at here is that the most extreme or riskiest assets are back testing support. There's also this inverse head and shoulders pattern setting up, not set up, on Bitcoin and on ARC. So if these things are holding up, is this like a little bit too much? Do we just go from extreme greed to extreme greed to fear really fast? Is it positioning, or what's causing this move? So we went from this is on what day is this? This is on February 3rd. So about 5 weeks ago, we're at extreme greed, 79, red lining. Okay, where are we now? Oh my goodness, back here into extreme fear. That's right. A week ago, we're at 53. A month ago, we're at 69. Yesterday, meaning Thursday, we're at 34. Now we're at 24. Whoa, that's right. Here's another reading. It's the most extreme reading. We only have about 700 votes so far. Thank you to everyone who does this. But 2 out of 3 people think this next week's going to be down. They've been flip-flopping, right? So they had up last week. That's the first time in like 5 weeks it was up. But 66 is our most extreme reading. So with all of that in mind, I have to really think about this quote here. It's okay to be wrong. It's unforgivable to stay wrong. I just like to say it's okay to be wrong. It's not okay to stay wrong. So that's what I think's happening. People are flip-flopping. And there's a few extra things we have to be mindful of because there is OPEX and quad witching coming up on Friday, which means there's a lot of options expiring. If we look at SPY and SPX on our option platform here, thealgo.com. Link in the description if you want to find out about that. We just note that there's a 2.48 put call ratio. We can also look here to our overview, and what we're looking at are orders over $100,000 in the last 30 calendar days that have not yet expired. If we show expired, the number will increase. This is money up for grabs. It's a lot. If we look at our overview, we can also note that SPX has about 5.5 billion in calls, 8.5 billion in puts. It has basically 646 million in calls, 1.6 billion in puts. QQQ 314 versus 820, which means we have a bear tilt. That's where we get that 2.48 put call ratio expiring going into the end of the week. We also have OPEX. OPEX is going to be quad witching this month because it's the quarter. So as we look here to March 17th on SPY and the 16s, which just means that we're looking at the most likely range with the markets moving fast. Here's what sticks out to me like a sore thumb. This is about $90 million in premium. Like call it $70 to $100 million in premium. Just that number right there, 233,553 at the 380 strike that expires in 1 week or on Friday, March 17th. Why does this matter? Well, that's 90 million bucks right there on a single strike, on a single ETF. And we look and see numbers that are big everywhere here, 385, 390, big flow. We look at SPX. Please just remember that these numbers here on SPX are going to be 10 times smaller just because SPX is the index or it's worth 3,000 points and SPY is worth less. So 3,500, 3,900, there is just a lot of interest in premium here. So now as we continue the story, we're going to get all this stuff out of the way. Then we're going to come back and look at some more charts because I think there are going to be some clues if we think about this pattern and what are the warning signs we want to look for, because I think it's going to be a very interesting next week. There's a lot on the line in terms of economic data, and the market got legitimately surprised this week. So let's go through and see what that was. So Larry Summers, let's just read what he says here. So this was earlier on Friday. So we're going to go from Friday to Saturday to Sunday. From Thursday to Friday. So this is 22 hours ago on the 10th of March or yesterday morning. Larry Summers, seen here, sees nearly 50-50 odds Fed must hike to 6% or higher. Oh my God. That's like what Mike Wilson wanted, right? He was talking about an earnings recession. So I think that the market was able to price in the earnings recession, but it was not able to price in the unknown. That's why VIX jacked up. We look at VIX here. Man, that's like a parabolic move. It is. We went from about 18 to about 29. That's a 10-point move. That's dramatic. If we look to the weekly now, it's not as like pronounced as. Let's actually go to this chart here, and let's go to. Let me actually make sure I got the right board here. I might have to open up a different one over here. So the reason why this matters is because if we look here to the S&P now, so here we're looking at the VIX. And we're looking here to the 1 week chart. We actually haven't broken the range. So because we haven't broken the range, I think what's so interesting is just that we haven't had a bout of volatility since about October, which is when we hit those lows. So every previous time here, we've had a bout of volatility, and we haven't really had a spike in volatility because there's a lot of things to be scared about, but they've been communicated, telegraphed, or forecasted for quite some time, which means the market's already kind of priced it in. And here's the part I find particularly interesting. We go here to SPY on a 1-day chart, and what we notice just that the percent decline on Jerome. So if we delete everything here, the part that I predicted, the first part, and it was correct, was that Jerome Powell did cause the leg down. That was the gap fill here. So we get the we stop going down, we get a gap fill in the chart, we go back down. I thought we were going to reverse back up and use the 50 as support, and it was working until it didn't. So what didn't work was that after the reversal and the gap fill, we didn't start going back up. But here's what I find interesting. The move from the high to the move to the low of Jerome, or the Powell dump, call it the Powell dump, that's about, I think it's like 2%. So Powell high to Powell low, this is about 2.5%. Okay, so it's about 2.5%. I have this in my notes as well. But then what about the SVB dump? Well, that's the Thursday high to the Friday low. Well, this range here is like a lot bigger. So we have to think about what the market is focusing on. Why did it go from extreme? Why did it go from neutral and even greed like a week ago to extreme fear? Well, because this move down here is twice as big. And we also didn't see a spike in the VIX on the day that Powell talked. So what does that tell you? Well, when Powell spoke, there was no surprise. There was no shock. There was no awe. But on Thursday, Friday, oh my goodness, people needed to buy insurance. And the ironic part is that people like Mike Wilson were positioned for a different reason by buying insurance. And we talked about before how there's been like record VIX buying lately. I'll see if I can pull up that screenshot really fast here. And the reason why I find this interesting is just because people were positioned for volatility or for fear, but for a different reason. So because it's coming in for a different reason, that's where the legitimate shock is coming in here. I don't know if I have it handy. Give me one more second. There we go. So if we look to this image here, which shows the VIX call buying, VIX average daily call option volume, right? In 2020, we had that huge spike. In 2021, 2022, 2023, it just keeps increasing. So what that tells me is that people were buying insurance and like, okay, well, it's called a black swan because no one sees it coming. The next day, Larry Summers tells us that there are very substantial consequences if this SVB does not materialize and work out. The next 13 days are the fate for the stock market. We talked about that earlier in the week. Mike Wilson talked about the death zone. Now we're going to talk about critical levels, the bull trap, which I'm stealing from him. We look here to upcoming earnings calendar. We had Fed Chair Jerome Powell, job numbers, CPI, PPI, ECB, and Fed decision. So we got CPI and PPI this next week, which are going to be important data points. But as I just showed you, the market actually cares more about this SVB thing than the rates and the current economic data. Why? Well, we got payroll Friday, and what's interesting about that is if we look here at the E-mini futures, we look at a 30-minute chart. Let's remove everything just for a second. As we go back here, what we're going to notice just that when at 8:30 when those prints came out, we go here to our calendar for this week. We had Jerome Powell testify. Joel Stubbers numbers came in strong, right? That tried to tank the market, didn't. Non-farm payroll came in up. Unemployment came in red. So some fuel for the bulls, some fuel for the bears. And on this headline number, again, mixed because green means bad. So good data is bad data is good. Well, we got one of each. What did the market do? And that was before we really started focusing on SVBs. We look here to 8:30 on Friday. All right. Sorry, where are we? Friday here, 8:30. There we go. So right here is where we got that knee-jerk reaction on the on the payroll number, and we went higher, and then it faded the open. So starting at about 9:30, right? Pump it up, and then just dumped it down all day. So there was definitely some manipulation at play here. That's what I want to focus on. So I think that the market can bake in all of these dates. I think the SVB thing is going to be important, and we both spend a few minutes going through that to try to just get a high-level overview of what the potential is this week. And then sure enough, there's already other bears out here. Like, yeah, right. They're coming out growling, right? That bear traps report. Founder Larry McDonald predicts stocks will crash. Right. He was talking about 30% in 60 days. I'm only telling you 10% in 30 days. He thinks we're going to be going down, down, down. So there's definitely this bear fuel out there. We see that positioning. It's a matter of whether or not we're going to see the follow through. So let's talk about SVB for a few minutes here. Here's how the second biggest bank collapse in U.S. history happened in 48 hours. This is the biggest bank failure since 2008. The highlights include the company downward spiral began late Wednesday when it surprised investors with the news it needed to raise $2.25 billion to shore up its balance sheet. This was a hysteria-induced bank run caused by VCs or venture capitalists. All told, customers withdrew a staggering $42 billion of deposits by the end of day Thursday, according to a California regulator. Now, those who remained with SVB face uncertain timelines for retrieving their money, which means this week there's going to be payroll, and companies are going to have to pay, right? They're going to have to pay their payroll. So if they come in and want to have to pay their payroll, it means, well, they're probably going to need the money. So if we go back here, just want to make sure I get my lines back. Where's my SPY chart? There we go. Make sure I get my lines back. There we go. So do you like getting your paycheck? Yes. Well, it's not just individuals. It's also people at SVB who are going to be using the proceeds or their corporate accounts or company accounts to pay for payroll. So this next week, like if that doesn't happen, there could be a run on the banks. That's the concern. That's why fear is high, is because you can only get shocked if it was not priced in. That's what happened. So SVB's 44-hour collapse was rooted in treasury bets during the bad word. So we look here to the treasury market. Oh my goodness, they tanked down 5%. Look at those fat red bars. 2-year note, it tanked. Went from 5.0 to 4.5. 10-year note, it tanked 4% down to 3. That's a dramatic collapse. Why did it happen? Well, because so it happened because of treasury bets. The treasury bets mean that they were in the treasury market, and the treasury market's been on an absolute tear. They're just the ones who got caught. Here's a number that's staggering, though. On Monday, the head of the Federal Deposit Insurance Corporation, or the FDIC, warned a gathering of bankers in Washington about a $620 billion risk lurking in the US financial system. Here we go. This is also from SVB. So north of 93% of their 161 billion in deposits are uninsured. So that's like really scary for people. It's a lot of money. So that's why we went to extreme fear, sorry. SVB is the 13th largest bank in the US. It's the largest bank collapse since 2008. They had $42 billion in deposits, withdrawn only on Thursday. Their total deposits are 161 billion, and the total risk exposure to the financial system is 620 billion. So what does that mean? I went through it before. I'm just going to recap it here. 2% on the Powell dump peak to trough. 4.5% on the SVB peak to trough dump. So bankers out there are saying it's not systemic. That's what kind of made us didn't go. That's what did not make us to go down further. But with OPEX in play and all that nice jazz with quad witching, it might get bad. JP Morgan's saying buy. Right, they're a buyer of SVB. Okay, because what? Attractive valuation. Morgan Stanley says funding pressure facing SVB is highly idiosyncratic. Should not be viewed as a read across to other regional banks. But fear and greed is what really happens. Fear and greed is what's going to drive the market. So if people have a sentiment fear, that's what's happening here. The saying was people were withdrawing first and asking questions second, and because that Larry Summers was calling for 6% or higher on the Fed terminal rate. Only on like Thursday. Well, this happened like pretty faster. We were priced to 25 basis points, right? So we were priced to 25 basis points. In real time, the market repriced. Fed swaps fully priced in 25 basis point cut by the end of the year. A repricing happened in real time, right? Because this may spread to other banks and regional sectors because we showed you there's 600 billion at risk. So here's what I think is happening. The market is looking forward to the Bank of Canada, who was looking to seek more evidence, and rates are now high enough, which means that Canada paused. Let me go to a different image here so we have something a little bit different to look at. Here we go, SVB. So if we think about Canada paused raising interest rates, the first of the developed countries. US is talking up 6%. Canada's number 2 banker, or the general here, right, number 2. Says it's time to assess if higher rates are needed, which means we're going to pause, then we're going to assess, then we're going to raise if needed. I think the market priced that in on Friday, what the Bank of Canada is doing, because they're pricing in the cuts going into the end of 2023, i.e., things are starting to break. And that's when the Fed changes monetary policy. The Fed thinks it can go higher, thinks it can go to 6%. The bond market is saying, I'm not so sure. And what's so interesting about this is that we look to how much money actually got liquidated. And if we look here, SVB liquidated they realized a loss of $1.8 billion. So if you had a bad week, don't feel so bad. They lost $1.8 billion in realized losses by selling off $21 billion of its available for sale securities, which probably means treasuries, which probably means that part of this move lower here on the 2-year note, on the 10-year note, is likely due to what we just heard from SVB. They sold 20 billion. Remember, like this market's like worth like 20 trillion. So 20 billion is a lot smaller than 20 trillion. The bond market is the biggest market. Sorry, foreign exchange is the biggest, bond market second, stock market's last. So even though this channel is called Stocks Today, we have to be mindful that this is not a very big sale relative to the size of the market. So the biggest risk is not systemic risk, it's confidence risk, because current withdrawals are only about 25% of the deposits at SVB, and they've paused withdrawals. 7% of the total risk exposure to regional banks. That's scary. And there you go, right? So in a banker speak, liquidity concerns translate roughly to the bank needs to come up with with some cash quick. To do that, SVB sold a 21 billion slug in government bonds, but because interest rates have not risen so much, bond prices fall when rates rise. It sold them at a loss of 1.8 billion. So the key dates that I thought would drive this week were important, but they were not the most important. We acted bullish to them, but that's why we have a bearish engulfing weekly candle, because the market just didn't see it coming. So here is where I'm unsure and where I'm going to be focusing on this week. We have CPI coming in this week, and we got PPI coming in this week. So we got core CPI, and if these numbers come in, like, they look constructive to me. Is it constructive enough to shake off all of this stuff? It's on Tuesday at 7:30. So if we're going to get that fallout, I could see it happening. And if we look here to our chart for SPY now, I'm gonna walk you through that game plan I mentioned at the beginning of the video. So here we have. Let's actually close that one down now. Let's look at the dates here. Tuesday, Wednesday. So we got Tuesday at 7:30, and then we got Wednesday at 7:30. That's when CPI and PPI both come out. Depending on whether or not the market, the number is red or green, meaning it's actually above or actually below. If the forecast comes in, I think that's constructive from 6.4 to 6, from 0.5 to 0.4, and then on PPI going from 0.7 to 0.3. I think that's constructive. Core retail sales also coming down. That's the soft landing. That's the story. That's what people are looking for. Initial jobless claims coming in at 200. We'll be looking for the ECB rate decision, CPI out of Europe. But if we're going to be getting a bullish reaction on Tuesday to the CPI and to the PPI, because that's the preview for me, we're probably going to climax on fear on Monday for SVB over the weekend. And if we now look here to our chart, I laid out a clear pattern we're looking for. So what was it? And tell me what I need to do because I am eager for the answer. What's the pattern we're looking at here? Okay, there we go. Right. So we got our double engulfing, ends up closing out with a bearish engulfing. That's the pattern right here. Check. All right. On the following candle, how high do we bounce? All right. Well, we bounce up here to the low from those two previous wicks. Right now, that's a 293 and a 292. 392, sorry, 393, 392. That's right here. So if we climax, say into like early week with SVB, and then we dead cat bounce back up on CPI and PPI, I'm going to be watching 393 to 394, which correspond with our 200 DMA at 393.16. So because you guys probably mostly look at daily charts, if we're below the 200 DMA, that's bad. It's quite bad. If we get that rejection off the lows, which would be a 393, 392. That's what we are looking for. It is that simple for me. And with that said, I'm going to thank you so much for watching. I would encourage you to subscribe to the channel because we're going to be going through updates all week. If not, there should be a video queued up now over here on the left-hand side, which is going to show you the what we look for going into this week. So you can look at a little bit more evidence if that interests you. If not, thank you so much for watching, and I look forward to seeing you on Monday. Thank you.